Good evening, everyone. Thank you for joining us this evening for this webinar on understanding the call spread. We're going to jump into that in great detail in a just in a bit. But before we do that, we wanted to give a little background on how this webinar will be conducted and then a little background about ourselves. As for this webinar, it's going to be held for the next hour. And if you have questions throughout the presentation, we encourage you to put it into the question area of the Zoom panel. It's a Q&A that's kind of symbol, a question symbol. If you can put your questions in there, you can also use the chat, but if you have a question, we prefer you put it in the Q&A areas because it's easier to kind of manage the questions that way. We will have a Q&A after the presentation. So Ernie is going to be monitoring the questions. So he'll try to answer as many as he can throughout the presentation, but he will leave some for me, or we'll try to answer as many as we can during the Q&A part of this webinar. With that said, let me provide a little background about myself. If you are new to joining our webinars, my name is O'Brien, and I have been trading the markets since I was a senior in high school. I got introduced to the markets by an economics teacher. That economics teacher had us follow stocks from the newspaper back then because the internet was very new, very few people had it. But I was kind of hooked, not kind of, I was hooked on the markets from following it from the newspapers and watching the first Wall Street movie with Michael Douglas. I knew at that time that I wanted to play some significant role in these markets. So if you fast forward several years, I eventually became a registered investment advisor. I held a license 65 for registered investment advisors and a license 3 for commodity pool operators. I needed those two different licenses to be able to run a volatility hedge fund that I did for a decade. And I'm now the CEO of Dorian Trader, which is an options mentoring firm that specializes in teaching individuals how to trade options. We'll discuss the Dorian Trader a little bit later. But for now, I'm going to have Ernie introduce himself, and then we'll jump into a quick little poll and then to the meat of this presentation this evening.
Cool. Good afternoon, everybody. Good evening. Good morning, in case you're calling from somewhere overseas. Ernie Rapp. I've been trading options for 12 plus years. My entry into the option marketplace, into the business world, completely different from O'Brien's. My father couldn't go to college. He had to support his mother and his wife, his two kids. And so he had a job after job, but he was a numbers guy. He wanted to be an accountant his whole life. So he kind of put that magic dust on my entire life and told me in high school and going into college I was going to be an accountant. So what did I do? I became a CPA. And I was indoctrinated into the financial world as though there was only one asset you should ever have. It's called cash. Cash is king. And I find myself 12 years into the option marketplace saying, man, I wish I would have been more like O'Brien and caught the bug a lot earlier in life, right? To be in the markets and understand how the ebb and flow of all these stocks and securities kind of work their way into people's net worth. 12 years ago, had a friend call me and said, hey, you want to learn how to trade options? I've got a mentor coming in from somewhere. And I said, sure, let's do it. And over a 2-day period, I was dubbed an expert. Then I spent 2 years trying to get my money back. Dug in, and about 6 years into it, O'Brien and I met, and we have been partnered in trading and mentoring ever since. It's been an absolute blast. And tonight we're talking about the good old call spread. Love that trade. Love that trade. Used to not play the call side, but have gotten very uh, comfortable with the call side compared to the put side. O'Brien, have you noticed that in the career of trainees that they you start them intentionally on the put side, or do you take them to the call side right away? What's their mentality when you first get kind of a new person in the option marketplace started? Calls, puts, or both?
So mostly puts, right? Mostly
Okay.
puts and but we do a lot of iron condors as you know. So
Yep.
it introduced them to the call side pretty early, but not not in the way you do it, which is a little bit more advanced.
Okay. All right. We won't go there tonight. All right. How about a poll? You ready for a poll, everybody? You are going to see on your screen in 1 second a very simple question. It's going to come up. Please participate with us, and we'll post the score of everybody that participates. How familiar are you with option trading? Brand new, some basics, comfortable, advanced. And if you are answering advanced, we want to hear from you and you're ready to teach a class, you need to call O'Brien or support at doriantrader.com and let's find out what you know. Love to hear people from the advanced world. We love the people from the beginning world. It's like a second language, which is fun to be able to say I actually understand a second language. But if you ask me for any other language like French or Spanish or whatever it is, it's like, no, not going there. Can't do it. Duolingo is not my friend. All right, we need a few more participants to give us a better spread of information here. So those of you who've not pressed the button yet, and there are quite a few of you, come on now, press the button, and we'll then allow you to see, just like we see, the distribution of how familiar are you with option trading. All right, we're going to close the poll in, what do you say, O'Brien? 10 seconds? 10, 9,
5 seconds, make it sooner, because I'm
5,
gonna
4,
probably yap a lot. And
3, 2, 1. Look at that. Interesting, interesting, interesting. All right, there you go. Some basics, half the group. Nobody brand new. Isn't that interesting? I've never seen that
I've
before.
never seen that either. And
Never
all the
seen that.
6 years, six and a half
Yeah,
years we've been doing this, never seen a poll that we did similar to this that wasn't brand new people.
brand new. That's
So
interesting. I mean, that's telling that people are more aware of the option marketplace than they ever have been in the past, I think.
yeah, yeah, that's true. That could be that we've experienced that, Ernie, with doing zero DT webinars with Dr. Metals,
Yeah,
is that when for the first several years of doing it, let's say the first 3 years of doing it, it was always most people never even heard of it or barely heard of it, never did it actually yet. Now it's the tables are turning. A lot of
mm,
people have pushed those buttons already for the zero DT trades, which is interesting.
very
So
interesting. Cool.
yeah. So
All right,
that's good. We're in a business that's growing.
there we go. Did I share the results? There we
uh,
go. I
yeah,
maybe
you
I
did share the
and then
results. I just
you
closed them.
stopped it. Okay, cool.
Yes,
Well, you close it again. Sorry about that.
no worries.
All right, I am headed to the background. I'm going to turn my video off, and if I could get everybody on the call, as always, to test their question box and tell me what city you're calling in from, and then we'll talk about that later. Okay, here I go. If you got a question, hit the question box. Tell me the city that you're in. I'll be in the background. We'll see you back at Q&A time.
Correct. Correct. So thank you, Ernie. As Ernie has just indicated, if you have any questions throughout the webinar, please put it into the question area of the Zoom panel here. We are going to be talking quite a bit over the next, let's just say, 60 minutes. I have a lot of stuff I want to cover. And so if the question pops up in your head, don't wait for the Q&A part at the end of this webinar. Put it in the question area. Ernie will answer as many as he can, and then we will have the Q&A as well. So this is understanding the call spread. We're going to try to go as deep as we possibly can on this webinar. You're going to leave this webinar with a lot more knowledge about the call spread than you came in. Well, at least that is our goal. Okay, that is definitely our goal. All right, I want to point out that we have several other main team members. Myself, Ernie, and Dr. Metals are owners of Dorian Trader. We have some very awesome team members in Awanza, Eric, Gustavo, and David. You'll get to know us all very closely in person because we do in-person events across the country. We have an annual retreat for members, so you would definitely get to know us not only through webinars but in person as well. Now, a bunch of you just got on the call now. My name is O'Brien, and why you should be listening to me this evening is because I specialize in options trading. I ran a volatility hedge fund for a decade, and I've been co-leading Dorian Trader for the last 6.5 years, and it's been just an amazing time of getting to know so many people across the country and other countries, and just helping people learn how to trade options. Trading these markets is my favorite thing to do, and I hope to be doing it for the remainder of my life. And if I'm fortunate, God willing, I will be doing this into triple digits and making money. That's the key. And we like to say here at Dorian Trader that options trading is black and white. You're either making money or you're not. It's no I woulda, coulda, shoulda stuff. We'll discuss that a little bit more later. But for now, this is a basic webinar, what we consider a basic webinar, understanding the call spread. So we're going to talk about the basics, but kind of gear it towards this call spread, and then we're going to break the call spread down in great detail. Okay, so let's do that now, and let's talk about the basics of options. So options are contracts called puts and calls. A standard put or call represents 100 shares if you're trading stock options. If you're trading options on futures, which we also teach here at Dorian Trader, it doesn't mean that. But most people start with trading options on stock. And one option always means 100 shares, two options, 200 shares. A standard lot of options is 100 shares. So it just multiplies by 100 every time you kind of increase the amount of options you are trading. Options can be bought and sold at different standardized strikes on an option chain. We'll talk about the option chain briefly in just a second. All options have an expiration date. So options can expire today, tomorrow, or years from now, but they will expire. Time is always ticking when you're dealing with options. And so that is the kind of built in leverage. It's going to expire. Options always expire. So here at Dorian Trader, we consider that the base of options is learning three pillars. It's three pillars to the base of options. The first pillar is understanding what is the call and the put and what's happening when you're buying and selling calls and puts. That's what you see on your screen right now. The second pillar is understanding the options chain and all the details around that, because that's where you actually buy calls and puts and understand probabilities and if you're in the money, out of the money, and at the money. We'll briefly talk about the option chain in just a second. That is the second pillar. The third pillar is understanding basic option strategies, because if you understand the basic option strategy, you'll be able to understand all the different exotic strategies that are created out there, because they're just deviations from the basic strategies. The call spread is a basic strategy. So that's why we call this more of a beginner's webinar, but we go into it very deep. So you're going to be able to leave this webinar, or at least it's our goal, that you leave this webinar knowing way more about the call spread than when you started, when you came and attended this webinar. Okay. So back to the pillar one. Now, looking at your screen here at Dorian Trader, we like to break it down into two parts. You're either buying options or you're selling options. If you are the buyer of an option, I want you to consider yourself the purchaser of insurance. You're going to a company like Geico and you're buying insurance. The option world and the insurance world mirrors each other almost identically, almost exactly. Okay? So if you are the buyer of an option, you are paying premium to someone. Monies are coming out of your account. And if you're the buyer of a call, you are bullish. You want it to go up, as this arrow indicates. The buying of a call is one of, if not the most way people start to learn about options. The number one way, I should say, people learn about options. It's a close second here where we'll discuss, but most people start with buying a call because buying of a call mirrors the buying of shares the closest when you're dealing with options. If you buy shares, you want it to go up. If it goes down, you lose. If you buy a call, you want it to go up. If it goes down, you lose. Okay? If you are the buyer of a put, then you are bearish. You want it to go down as this arrow indicates. And now this is where options become confusing to most instantaneously because it's counterintuitive of what we're used to. Normally, when we're buying something, we want it to go up in value. But when you're buying a put, you actually want it to go down to be able to make money. So that's once again counterintuitive to what we're accustomed to. So it becomes confusing to everyone at this point. But what I want you to understand at this time is that if you're the buyer of a put, you're bearish, and if you're the buyer of a call, you're bullish. And if you're the buyer of either one, you have a right. You have a right to do something, but not an obligation. Right? You have a right to do something. So if you're the buyer of a call, you have a right to be able to purchase at a strike price. We'll talk about the strike prices here in a second. If you're the buyer of a put, you have a right to sell at a strike price, but not an obligation. Now, if we jump over to the right hand side of this image, the sell side, this is the side where we say you become the insurance company. You become a one woman or a one man Geico operating in the open market because you are selling options to people that pay you premium into your account instantaneously that you never have to give back. You're acting like one woman, one man or one woman insurance companies in the open market. If you sell a call, you are bearish. You want it to go down as this arrow indicates. You're receiving monies into your account. If you are the seller of a call, you're bearish. It's the opposite of buying a call, as we discussed. You're bullish if you buy a call, you're bearish if you sell a call. So you can be bullish or bearish trading a call, trading only a call. But it all depends on if you're the buyer, which is bullish, or if you're the seller, which is bearish. Monies are coming into your account. Now, a lot of people say, how can I sell something I do not own? This is the kind of beginner's type of question. Well, in the options world, the option that you sell does not exist yet until you sell it. You create it. You put it into existence. Literally, just like if you're going to Geico to buy insurance from them, and if you've never been with them, and even if you have, the policy that you're signing with them does not exist. They write it into existence. And you have to agree on the terms, and they have to agree on the terms, and then the policy is effective. That's the same thing in the open market with options. The option you sell, you are creating it, literally. It does not exist until you sell it. Okay? It does not exist until you sell it. Now, if you are the seller of the put, you're bullish as this arrow indicates. Monies are coming into your account and you never have to give that back. This is probably a 1A where people start at with understanding options or starting with trading with options is selling what is called a cash secured put. It could be the most conservative strategy in trading, period. Is selling a cash secured put. So if you're the seller of a put, you're bullish. If you're the buyer of a put, you're bearish. So once again, you can be bullish or bearish using only a put. But it all depends on if you're buying it, that's bearish. If you're selling it, that's bullish. So we like to tell people here at Dorian Trader, you need to memorize this image here. You need to memorize it on a daily basis until you can put it into your long-term memory. Because if you're thinking about what is happening if you're buying a call or if you're selling a call, then you don't understand the options well enough yet. If you're thinking about it, you do not understand it well enough. Now think about that, right? You need to, it should be unconsciously just that you know what's happening. Someone says, I bought a call, you know it should be bullish right away. You ain't even thinking about it. If someone said I sold a call, you know it's bearish. You know it already right away. And if you don't, trust me, you do not know it well enough yet. memorize it. And I don't like memorization type of work, but this is what you have to do when it comes to this first pillar of the basis of options. We're going to be discussing the buying of calls and the selling of calls because this is the call spread webinar. When we're talking about putting these together, the buying and selling of them, putting them together to create what is called a call spread, a vertical spread, up and down type of spread. Let's jump over here to this option chain really quickly. And an option chain is normally set up that calls are to the left. These are all calls to the left. To the right are all puts. The separation is done by the strikes. The strikes are down the middle here, this vertical area. These are the standardized strikes that we mentioned before. These strikes are created by the exchanges, like the New York Stock Exchange, the Nasdaq Stock Exchange. They create these strikes. Okay. Now, once again, calls are to the left and puts are to the right. This orange or brown horizontal line going across the Tasty Trade platform here, this is what is considered the at the money line, the ATM. At the Dorian Trader, we consider the at the money line the equilibrium, the baseline. Everything is either going towards it or going away from it. The at the money line should always be easy to identify because it's exactly where the stock is currently trading. So the SPY ended today at 693.07. That's basically in this area here. You always need to start with the at the money line. Because once you understand the at the money line, then you can understand where something is in the money or out of the money. On the call side, above the at the money line is what is called the in the money area, the ITM. Below it on the call side is the out of the money area, the OTM. And on the put side, it's the opposite. This is the OTM, out of the money area, and this is the in the money area, the ITM. So when you're learning the base of options, you need to understand these definitions. We talked about when you buy a call and when you sell a call and when you buy a put and sell a put, where when you understanding the option chain, you need to understand what is at the money, what is in the money and out of the money, because when you're trading options, you have things that's called rights and obligations. If you are a buyer, you have a right to do something as we indicated earlier. If you are the seller of something, you have an obligation to do something. If you're the seller of a put, you have the obligation to buy at a strike price. If you are the buyer of a put, you have a right to sell at a strike price. And if you're going to live up or exercise your right, that's normally going to be done in the money area. If you're going to have to live up to your obligation, that's also normally going to be done in the money area. And when you're talking about probabilities, which options are awesome to understand your probabilities, when you're talking about having high probabilities, better than a 50-50 shot, things like 80% chance, 90% chance, 99% chance, that's going to be done in the out of the money area here. So you want to understand where you're at on an option chain in the beginning of the trade and throughout the life cycle of that trade. When you're dealing with an option chain, you also want to know where the ask and the bid is at. It's on both sides. Once again, it's the call side is the left-hand side, the right-hand side is the put side. The ask is where you can buy at. Here on the Tasty Trade platform, they put in buy. The bid is where you can sell at. Here on the Tasty Trade platform, they put in sell. Here at Dorian Trader, we like to tell people you want to buy and sell at the mid price. That's in between the bid and the ask is the mid price. You want to buy and sell on the mid price or at least as close to the mid price as you possibly can. Okay. Now, also on an option chain, you have delta. You should have delta on your option chain. If you don't have delta on your option chain, you are not a true option trader. If you don't understand delta, you're not where you need to be with trading options. Delta is ridiculously important when it comes to trading options because it measures two important things. The most important two things when it comes to trading options. Number one, delta measures your directional risk. What can be more important than that? Number two, delta measures your probability of success. Now, ask yourself this question. What can be more important than that? Those are equally as important. As for directional risk, delta measures how much you will lose based on a 1 point move, up or down. So if you had 100 shares of company SPY, this is the ETF, the S&P 500 ETF, the first ETF ever and still the most popular ETF, or company XYZ or ABC, whatever company, if you had 100 shares of that company, each share represents 100. Each share represents one delta, I should say. So if you had 100 shares, you have 100 deltas. And it's static. Static means it stays the same. It will stay the same until you change the amount of shares you have, until you increase it or decrease it. But it always will stay the same until you change it. So if you had 100 shares of SPY, you would have 100 deltas, positive deltas of SPY. And so what that means, if it went up 1 point, you would make $100. If it went down 1 point, you would lose $100 because delta measures how much you will make or lose based on a 1 point move. Now, as for delta when it comes to options, now that's a little different, meaning that it still measures how much you will make or lose based on a 1 point move, but option delta is dynamic, meaning it changes. It's always going to change. So if you start off and let's just say you bought or sold a delta at 40, what that means is it's going to move 40 cents for every $1 move initially. Okay. If you had an option that you started trading with the 50 delta, it means it's going to move 50 cents for every $1 move. If you had a delta that was 1 or 100, it means it's going to move dollar for dollar. But it's not going to be static. It's going to be dynamic, meaning it's going to change. It's going to either eventually go to 1 or 100, or it's going to go to 0. Okay. All options that expire out of the money have a 0 delta at expiration, at the time of expiration. All options that expire in the money have a delta of 100 at the time of expiration. So it will change 100% of the time. If you're trading options, that delta will change. But initially, it tells you how much your risk is, how much that option is moving per every 1 point move. So initially, it might be 50, and then it might be 30, and then it might be 70. It's going to change. Okay, that's delta measures how much you will make or lose based on a 1 point move. When they're dealing with shares, which are static, when they're dealing with options, which are dynamic. Okay, now the second thing that we were talking about delta measures a second thing, and that's probability of success. So let's go back to this at the money line here. This orange horizontal line going across the Tasty Trade platform here. This is the at the money, the ATM. As I mentioned before, here at Dorian Trader, we consider it the equilibrium, the baseline. Everything is going towards it or going away from it, right? This is your starting point, your baseline. Now, if you're going to buy or sell something at the money, you're going to have a 50-50 shot. You're going to have a coin flipping chance of making at least 1 cent at expiration. Option probabilities are based on making money at the time of expiration, not a second before and not a second after. If you're going to buy something at the money, it's almost like buying shares. If you buy shares, at least initially, you have a 50-50 shot of it going up. Maybe over time, especially with this SPY, it's going to drift up over time, right? The S&P 500 is going to drift up over time. But any single day, any time you start initially, it's a 50-50 shot. It's a coin flipping chance. And technically, it's a little worse for the option purchaser and a little better for the option seller. Okay, now where the probabilities change dramatically in favor of the option seller is when something is out of the money, the OTM. In this area on the call side, and this is the out of the money area, the OTM on the put side. Okay, now we're going to be talking about the call side today. So if I was going to sell an option at this 30 delta, actually, let's switch that. Let's say if we we're going to buy an option at this 30 delta, when you buy something out of the money, the delta that you buy at tells you your probability of success. So if we bought at this 30 delta, we would have a 30% chance of making at least 1 cent at expiration. You guys, options can predict the future with a win rate of 68%. Because of time purposes, I'm going to go into it in too much detail right now, but what I want you to understand that options can predict the future with a win rate of at least 68%, one standard deviation of the time, where the options predict something is going to expire at within a range. It does that at least 68% of the time. So if you buy an option that is out of the money, the delta you buy it at is going to indicate your probability of making something at expiration. Once again, all probabilities are based on the time of expiration. So in this case, 23 days from now at the time of expiration, not a second before and not a second after, but literally the time of expiration. Now, none of us would say 30% is great odds, right? But if you buy this option at the 30 delta and if you don't understand what delta means, you can think you have a high probability of making money when you do this. You will be mistaken. But if you sell this option, if we flip it, if you sell this option at the 30 delta, then your probability of success is the inverse. Instead of having a 30% chance of winning at expiration, you're going to have a 70% chance of winning. Now, that's not bad. If you learn how to manage your trades correctly, you can make a ton of money off a 70% win probability. Just like casinos can make a ton of money off a 51 to 49 win probability. It's always about managing your losses, managing the risk. You would have a 70% chance of making at least 1 cent at expiration. So if you sold an option at a 15 delta, you would have an 85% chance of making at least 1 cent at expiration, winning, not losing money. If you sold at a 10 delta, you would have at least a 90% chance of making at least 1 cent at expiration, not losing. If you sold at a 1 delta, you would have at least a 99% chance of making at least 1 cent. You're not going to make a ton of money doing that here on the call side, especially on the call side. You're going to make $7 or $8 here, but you would have a 99% chance of not losing. Options give you the ability, if you're the primary option seller, if you're acting like that insurance company that we talked about earlier, being the option seller, you can predict your probability of winning and you can have a win rate of 99% if that's what you want. Here at Dorian Trader, we usually have at least an 85% chance of winning on almost everything we do. But you do not want to be fooled by probabilities, right? Because option probabilities are based on the time of expiration. A lot of things can happen within this 23-day period. So it's also something that's called the probability of touch. And that's basically a back of the envelope, back of the hand calculation of 2 times delta. So if this delta is a 30 times 2 is 60. So you have a 60% chance it's going to touch this 704 strike within the next 23 days. So more often than not, it's going to touch that 30 delta strike, that 30 delta option. So if you don't understand that, once again, if you are being taught not to understand delta, or if you're not being taught delta, then you are driving blind. You're trading without the most important two. I don't often sell options at a 30 delta unless I'm okay with owning shares on the put side or something like that, because I understand that the probability of touch, the probability of me getting threatened on that trade is 60%. So more often than not, I'm going to be threatened. I don't like to be tested. I like to tell members of Dorian Trader that I'm a chicken. Even though I can adjust probably better than almost everyone out there, and that's not a boast. You can see some of the videos on YouTube of me adjusting live. I can adjust with the best of them, but I still would prefer not to adjust. I would still prefer not to be challenged. I want things to go as smooth as possible. I just want to collect the checks that options trading provides you. I know that's not reality 100% of the time, but I want it to be as close to that as possible. And I'm always trying to strive for that. What I want you to understand is the delta you sell at out of the money, the inverse is your probability of success. Remember that. We're going to be talking about that a little bit more throughout this call. All right, so let's jump over here back to the PowerPoint here. And I want to point out to you guys that I went over some basics. We're going to go over it a little bit more with the call spread here in a second. But if you want to really learn the basics at a high level, go to our YouTube channel, type in, or go to YouTube, type in Dorian Trader, subscribe to our channel. You can see a bunch of videos on the basics and a bunch of videos on other stuff. Support us that way. We thank you in advance for that. Also, later in the call, I'm going to give you an offer to join Dorian Trader for $30 per month for a 3-month trial. And we believe this is this is why we have this image here, a shocking offer. I don't want you to say yes or no now. I want you to continue to understand and see if you can learn something from me today. And if my cadence, if my learning style or teaching style, I should say, is something that you're interested in, then we want you to join. We want you to join. $30 per month for a 3-month trial with the code START now. We're going to talk about that later. Let's jump into this call spread now. So, what is the call spread and what are its mechanics? The call spread is when you buy or sell a single call at a strike price and simultaneously sell or buy another single call at a higher strike price. I'll explain this in a second. Just kind of setting the framework. For example, you sell a call at the 100 strike price, and at the same time, you buy a call at the 110 strike price. This is considered a 10-point wide call spread. It's a vertical spread. You'll hear that term. Okay, you'll hear that term, a vertical spread. If we continue, it's two type of call spreads. Okay, it's a bullish call spread and it's a bearish call spread. What is a long or bull call spread and why should I use it? Now you're going to hear people use this type of terminology. Some people are going to call it a long spread, long call spread. Some can call it a bull call spread. The long or bull call spread is a vertical spread strategy that creates a net debit in your account. That's money's coming out of your account. You're going to the insurance company and you're buying insurance. For example purposes, you guys, a debit is coming out of your account. Cash is leaving your account. The option you buy, this is key to understanding this. The option you buy is always more than the option you sell. The bull call spread is used to go long and underline or to hedge against a bearish position. Now, let me break this down. A bull call spread will look something like this. If you buy this call, let's say near the at the money price here, and let's just say we did a 5-point wide spread here. Okay, so this option right here is the one you're buying. It's more expensive than the one you're selling. So that's what makes up an overall debit, as you can see, a $304 debit here. The value of the spread is based on the 5 points. So this is 694 to 699. That's 5 points. Each point with options, when you're dealing with options on stock, equal $100. So 100 times 5 equals 500. This spread is worth $500. So you can make 500 minus what you paid. So you paid $304. The most you can make on this trade is $196, as the Tasty Trade platform is giving you. It's a great platform to give you all this information. But you need to know how they're gathering this information just in case something goes wrong with the platform and they're giving you bad numbers. You should be able to easily see this and know what's going on. Now, as you can see, we're doing this at the money. Tasty Trade is telling us we have a 44% chance of winning something at expiration. I told you that if you buy something at the money, you have a 50-50 shot, but most of the time, if you're the buyer, it's less than that. It's almost all the time less than that. You can just say it's less than that. But for simplicity purpose, if you doing something, buying something or selling something at the money, consider it a coin flip, as we said earlier. When you're doing this spread, you're going to have to put up the max loss. And that's the max loss is what you paid, which is 304. So that's your buying power. That's your collateral. If you're doing a call spread, you want it to go up. This is the at the money line where I'm putting this at. If it goes up and supersedes what you paid, then you can win. If it goes down, you're going to lose 100% of the time. You need it to go up. If we put analysis here, you'll see that I don't know if I have any SPY stuff on. Do I have any SPY stuff on? No, I don't. All right, so it's going to be a little gray area here. That's the amount that you paid. Okay, you have to supersede that at expiration. All right, so let's move on. Jump back to this table here. All right, so if we jump back over here to this PowerPoint, and let's talk about what is a short or bear call spread and why should I use it? The short or bear call spread is a vertical spread as well. It's a vertical spread strategy that creates a net credit in your account. Monies are coming into your account now. You're acting as a one woman or one man Geico. You're being the insurance company. You're receiving monies into your account for something that you sold, for that policy you sold. The option you sell is always more than the option you buy. On the other side, you remember when we were talking about the debit, that was the option you buy is always more than the option you sell. In this case, the option you sell is always more than the option you buy. The bear call spread is used to make money as the underlying goes down. It can also be used to offset long positions. It's a little bit more advanced, but that's what it can be used for. Now, if we flip this, okay, I'm just using this as an example. We flipped it. Now, what we're selling is the more expensive option leg. This is the less expensive option leg. Now, if I didn't point this out before, a vertical spread always consists of two legs. This is considered one leg. This is considered one leg. You add them up, it's two legs. A vertical spread is always two legs, never less and never more. It's always two legs, a vertical spread. Now, in this example, the risk or the value of this spread is still $500 because this is 5 points. We just flipped it. But now instead of paying 304, you're receiving 304 in this example. Someone's giving you $304. So now your max loss is the inverse. Your max loss is $196. That's how much you have to put up in buying power. That's the collateral you have to put up is your max loss there. Now, instead of having a 44% chance of winning, it is flipped. We now have a 56% chance of winning at expiration. The odds have flipped in our favor. This is a bear call spread. A bear call spread. Now, if we go back to this curve view here, you can see here that this is the at the money line. And if it goes up, we're going to potentially lose. If it goes up too much, we're going to lose. That's our loss zone. If it goes down in any amount, we're going to win. Okay? This is a bearish call spread. Just flipped it. The one we sold is more than the one we bought. All right, so now let's jump back to this PowerPoint and let's talk about what is the best way to use a call spread to go long the market. What that means is be bullish the market, positive on the market, happy and energetic about the market going up. The best way to use a call spread to go long the market is to make sure the probabilities are at least 50-50 by buying a spread at the money or a little in the money. And this is a little misleading because most of the time it's going to be less than 50-50, especially if you're buying a single call. But we're not talking about single calls, we're talking about spreads. So going back, if you're going to, best way to do it is what I showed earlier. You're either going to do something like this, buy at the money here, okay? Or you're going to buy something a little in the money, something like this, right? That increased those odds a little bit better, as you can see. And you're going to let it play out. But a little trick you want to understand is that probabilities of options, and I'm being repetitive here on purpose, you guys. Probability of options tell you that you're going to, or what percentage you're going to make, or what percentage you're going to win, I should say, at expiration. Do you have an 80%, 90%, 10% chance of winning at expiration? Well, if you are the buyer of something like this call spread, you're not going to have a 50-50 shot if you wait to expiration. But if you get out before then, you can increase your odds. And a lot of times you can increase those odds to 60% or higher. Get out at 50% of what you can make. That will increase your odds to most of the time at least 60%. So here on Tasty Trade, they're giving this probability of if you get out at 50% here, you have a probability of 76% of getting 50% of what you paid here, or about $150 basically. Okay, $156 to be exact. That's how much you can make. It's not 100%, but that's a little nugget. Do not hold stuff that you buy to expiration. Get out at 50%. It's going to increase your odds. A lot of times you want to get out at 25%, increasing your odds. This is a probabilistic game, you guys. Play it accordingly. All right, so let's jump back over here and let's say, what is the best way to use a call spread to short the market? The best way to use a call spread, in our opinions, to short the market is to make sure the probabilities are on your side based on the strike prices you use. We believe that is between a 5 and 15 delta. So the beautiful part about selling a call spread, I just say at this 15 delta here, and I just do a 5-point wide again. We're going to collect $81 here, but based on this delta, we're going to have an 85% chance, if you go by this delta, of making at least something at expiration. We're going to have to put up our max loss, which is our collateral, the buying power here, the 419. But if we jump over here to this curve view real quick, I want you to see that this is the at the money line. And let's just make that a little bigger so you can see. Let's move that a little back like that. So this is the at the money line. If it goes down in this direction, you're going to win 100% of the time if it goes down, if you sell this call spread. But even if it goes up, you're still going to win, because you see this green, you're still going to win 85% of the time based on that 15 delta. If it goes too much up, then you're going to lose in this area. You have a defined amount you can lose because of this is a spread based on this call that you bought. This is a spread that you put on simultaneously. It's a built-in stop loss. The most you can lose on this is 419. Okay. All right. So let's move on and let's jump back to this PowerPoint. And how do you use a call spread to hedge? We're giving you all these kind of ways to use the call spread. The best way to use a call spread to hedge is to use a starting strike price that provides a good hedge for the least amount of capital and that provides a realistic chance of making money on the hedge if used to protect a bear call spread or spreads. So what we like to do is if we're going to hedge something, let's say the the market is going up a lot and we want to hedge some bear call spreads that we sold. Well, a lot of times we like to buy at or near the 30 delta. So if we did this, for example, and I'm just going to use a different type of spread here, a one point wide spread here. We can even do a 2 point wide spread here. If we bought this, we would have a 30% chance of making some money at expiration on this hedge. But a hedge is a hedge. You don't want to make money on a hedge. You want to make money on what you're hedging. But this will give you a good balance. You have a 30% chance of making money on this hedge, and you have a 60% chance, probability of touch again, you guys, 60% chance of touch this beginning of this hedge. So this is a really good balance between it helping you and the cost of it. Okay. This is what we teach you here at Dorian Trader. All right, so let's continue. So, is it better to sell a call spread in the SPX? We're going to give you kind of these choices: a cash, the cash settled index, right, or the ES futures index. Well, let's check. But before we do that, we want to tell you how we can help you here at Dorian Trader. We can help you get set up on a trading platform like Tasty Trade, Thinkorswim, or Interactive Brokers in that order. We can help you not only sign up with that brokerage firm, but set up the platform so it can mirror ours so you can accelerate the learning process. We can help you make 2 to 5% per month or 24 to 60% annualized. That is our value propositions, is to help you learn how to make money in a meaningful way that can at least supplement your income. And if you have bigger aspirations, make it your primary source of income. We want you to learn how to make 2 to 5% per month like clockwork. That is our value proposition. No, we can't guarantee that, you guys. We're not charlatans. But we tell our members if we can't help you do that, or if you're not doing that, come talk to us and let's see if we can help you. Let's see what kind of tweaks we can make. And if we still can't help you do it, then you shouldn't be with us. Because as I said earlier, trading options is black and white. Trading is black and white in our opinion. You either making money or you're not. It's no I woulda, coulda, shoulda stuff. You have to be making money. I want to make money daily. Is that realistic? No, you're not going to make money every day. I want to make money monthly. Is that realistic? No, you're not going to make money monthly. I want to make money every quarter. Is that realistic? No, you're not going to make money every quarter. I want to make money every year. Is that realistic? Well, I think so. I never want to have a losing year. I'm going to have periods of time when I'm down, but I want to make money year after year after year. If you join the Dorian Trader, you'll see this. I'm serious about making money, and I want you to be serious about making money. We teach you the basics, find trade ideas, understand your portfolio, how to use proven trading strategies. We teach you how to manage risk through directional risk with deltas, hedging, fixing trades go wrong, taking profits, teaching you how to ring the register. So many of us get big gains in things and forget how to ring the register, or don't know how to ring the register, or do not want to ring the register, and then we give back a lot of our gains, if not all of them. That's a tragedy. Here at Dorian Trader, we have 4 main programs that we pitch, that we have. We have an options training cohort. That's a 3-month group learning environment. We do it on the 1DTE strategy, the 7DTE strategy, the safeguard strategy. We do cohorts in those type of strategies. You can go to our website and learn more. We have a 1DT strategy or cohort starting on March the 19th if you're interested. We have what we call the Disciplined Trader, which is a one-on-one 6-month program that you'll learn how to be a disciplined trader by learning from me. Then we have our biggest program, what we call the apprenticeship program. This is where you'll basically follow me around for a year. I'll fly out to you, spend 14 hours with you in person, and then we'll meet on a weekly basis, this talk on a daily basis. You basically follow me around for a year. This is where you want to be a full-time trader. You want this to be your job. We call it the apprenticeship program. But what we pitch on all of our calls, if not most of our calls, is our trading club. We believe our trading club is the most robust, most comprehensive trading club on the planet, and we are not using hyperbole here. If you decide to join our trading club, you're going to get course one in the video library included in a trading club. Everyone has it as a member of Dorian Trader. It's access to hours of unique videos and self-study and quizzes. You'll get 25 plus hours a week of live programming, mornings, afternoons, and evenings. You will have access not only to your chat area as a member, you'll have access to your mic to be able to interrupt the instructor, and we encourage members to do that so we can't cherry pick questions. You have access to share your screen. So if you need help putting on your first trade, or if you need help trading a certain strategy, you'll get access to your camera. This is unheard of in any other trading club group out there, you guys. And this next thing that I'm going to mention, I dare you to kind of find a trading club out there to do this. We Every member of Dorian Trader gets 911 help into perpetuity. As long as you're a member of Dorian Trader, you get 911 support. You just jump on a call, you go into the 911 help room, you get the help you need, and then you can come back to the main room. 911 support into perpetuity. We have what we call follow, learn, and earn, where you can follow trades that I do on a weekly basis on Wednesdays in the morning or afternoon or both. I put on 4 trades in the morning and 1 trade in the afternoon that you can follow. You can follow all of those trades, or you can follow some of them or none. You can decide. But what I promise members is that whatever trade I put on, I do not touch that trade again until the following Wednesday. So you don't have to worry about, did you miss a text? Did you miss an email? Did you miss an adjustment? No, I will not touch that trade again for the following week, because I want you to understand that our signature strategy here at Dorian Trader is called the safeguard strategy, and you do not have to worry about adjusting it every single day or on a regular basis. You can take your time, follow and earn. We don't want you to be robots here at Dorian Trader. We want you to learn how to feed yourself. That old adage. We want to teach you to fish so you can eat forever instead of giving you a fish so you eat once. We want you to learn how to trade on your own, but we're going to be there to hold your hand if that's required. You guys, a shocking offer. $30 per month for a 3-month trial. After that, it's $125. You can try us out. You can cancel at any time. It's our job to make you understand, or convince you, I should say, that the value we present is worth every penny, if not more. We want you to learn how to make money to at least supplement your income. And if you once again have bigger aspirations, help you become a full-time trader. $30 per month, you can cancel at any time. With the code START NOW, Ernie has put a link in the chat area. On that Zoom panel right there, link in the chat area. Click that link. It's going to take you to our website. You're going to still be able to hear me yap. I encourage you to do that, because it's more important to sign up to get the learning process started. You'll be able to join us tomorrow morning, what we call the alchemy of a trade. We go over the process of how we create trade ideas, how we put on trades. You'll be able to join us on Friday morning, what is called the trading floor, our most comprehensive live programming. It's time to start learning to trade options. If you sign up before this webinar is over, you will get the Options Bootcamp mini course for free. You'll get the Options Bootcamp mini course for free, which will teach you a huge amount of about the basics of options, I should say. It'll teach you about the basics of techno analysis, and then it'll answer 10 questions you should have answers to. The Options Bootcamp. It's an awesome course you'll get for free, $300 value. Here at Dorian Trader, you guys, you'll learn this if you decide to join us. Our mission is to eliminate failure when learning to trade. We do not want you to learn to trade anymore by blowing up your account. That's an antiquated way of learning how to trade. Here at Dorian Trader, we do that. We live up to that mission by talking about and living up to what we call the 3Ds. A desire, a deep commitment to becoming a skilled and consistent trader. You have a desire because you're on this call, you're on this webinar. But is it a deep commitment to becoming a skilled and consistent trader? Dedication, the work ethic to show up, study, and follow the process daily. And discipline, maybe the most important of the 3Ds. The ability to follow rules, stick to a plan, and manage risks at all times. We don't want members to blow up their accounts, you guys, so we encourage members to put 80% of their monies in their trading account into what we call the safeguard strategy. We wrote a book on it that's called This Strategy Killed the Wheel. It's comparing the safeguard strategy to the wheel strategy. None of you probably heard of the wheel strategy. We believe the wheel strategy is a good strategy, but it's like the wooden wheel. And the safeguard strategy is the rubber wheel. Is the rubber wheel perfect? No, but it's significantly better than the wooden wheel. If you sign up before this webinar is over, you'll get this book for free as well. Okay? Now, is it better to sell a call spread in the SPX cash index or the ES futures index? We believe the answer should be based on capital efficiency if all else is equal. So for example, if we go over here and let's go to the SPX and let's go out to 49 days. And let's sell a call spread at the, let's just say the 10 delta here, you guys. We're going to pick the closest 10 delta to at the money. And we're going to do a 10-point wide spread. I don't know if it's going to be apples to apples, but let's see. We're going to try. So 10-point wide spread, we're going to collect the dollar if we did it in the SPX, and we're going to have $900 at risk, and we're going to have to put up $900 of collateral, okay? And we're going to and because this is a 10 delta, we should have a 90% chance of winning based on the delta, okay? Now, if we jump over here and we go to the ES and we do the same kind of thing, we're going to try to be apples to apples. We're going to go to something near 49 days. So in this example here, unfortunately, we got 51 days, but that's close enough. What I'm going to do is go to this 10 delta, closest at the money. I just say this 9 here. And unfortunately, we can't do 10-point wide because they don't have it here on this 51 days, but they have a 25-point wide. But I want you to see the difference. Right? We're collecting $100, the most we can make. Right? We're collecting $100, but the buying power is, even though we're doing something wider, the buying power is still significantly lower. Instead of 900 is 700. Okay? So when you're using options on futures, you get on most of the time, not all the time, and we'll explain when it's not, but most of the time, you get to use your capital significantly more efficiently. And so if you join the Dorian Trader, you will learn how to trade options on futures. Also, as you learn how to trade options on stock. Okay. All right. So let's jump back over here. I know a number of you are already signed up, but I want to point out before we jump into this Q&A, I'm going a little over. I apologize for that. Ernie, I knew I was going to yap a lot tonight, and I tried to cut some of this down. But if you're hungry for more, you guys, you can go to DorianTrader.com, click on the events, and you can see when we're coming in person in your area. You can see the next webinars that we have. You know from joining this webinar this evening that we just don't push joining Dorian Trader. We teach you something. We do teach you something. You know, every webinar we're about teaching. And if you join our trading club, that's going to be on steroids. We're about teaching. Now, to emphasize that, if you decide to join us, you'll have the option to have one-on-one onboarding, which is a $300 of value. You have access to course one in the video library during school, $700 value. You have live morning market briefings and trade ideas, $2,000 value. You have access to Beginners Hub, a weekly small group teaching class. This is every Thursday night, you guys. It's a Beginners Hub that you get to come and ask all your beginner questions, and every question is fair game except adjusting because we don't consider that a beginner. $400 value. Live teaching classes on Wednesday and Sunday nights, $800 value. Admission to the trading floor every Friday, $400 value. I mentioned this is our most comprehensive live program that we do on Friday mornings. It's called the trading floor. Trade ideas emailed out every Tuesday and Thursday, $800 value. 911 emergency help, $300 value. As I mentioned, this is into perpetuity, so it's more than $300 value. Cloud recordings of all live programming, $800 value. Platform setup assistance, $300 value. Unlimited questions via email, text, and phone, $300 value. And a complete access to member-only Discord. It's no Wild Wild West. It's only members in our Discord. If you own our Discord, you are a member, $200 value. This is over $7,000 of value, you guys, just to join our trading club. Over $7,000 of value. You can get it. You can try us out. You can kick the wheels. You can test the Lamborghini for $30 per month for a 3-month trial. $30 per month for a 3-month trial with the code START NOW. You can click the link in the chat area that Ernie put. That will take you to our checkout area. You fill out a few things really quickly and you'll be a member of Dorian Trader. Okay, we'll talk about that a little bit later on what you'll see right away. But $30 per month after the 3-month trial is $125. That's our regular discounted price. Okay, you can cancel at any time. If you sign up before this webinar is over, you can get the Options Bootcamp mini course for free. As we said, you'll also get a copy of our book, This Strategy Killed the Wheel, for free. Ernie, you can come back on camera. Let's see what we got questions wise.
You win the award, O'Brien. You have the highest word count per minute. All right, let's get going. Got some great questions. How wide is right? How wide is right on these call spreads? You saw
How
10
right is
point
right?
wide.
Okay.
How
Okay.
wide is right? You saw
So,
that you were 10 point, 50 point, 25 point.
uh,
Where do they even begin with this stuff?
so here at Dorian Trader, we're going to introduce you to a 100-point wide call spread. It's almost like a synthetic strangle. And we're going to do it in the ES of what we showed here in a second, or what we showed a second ago. We're also going to do a lot of 10-point wide spreads, what we do with our 7DTE strategy. That's a weekly option strategy. We're going to do a lot of 20-point wide spreads. So you're going to get the gamut. You're going to learn how to use call spreads and put spreads. You're going to learn how to determine what spread amount you're most comfortable with, right? You might be like, for example, with 0DT trading, I'm comfortable with a 20-point wide spread. Dr. Meadows will sometimes do 150-point wide spread on a 0DT trade. It all depends what you're comfortable with.
So we just had a
But we
question
do
come
have a
in.
standard though. Go
Yeah,
ahead.
we just had a question come in specifically about this conversation is how
Mhm.
much is the ideal amount of premium to collect based upon the width of a spread?
So
It's an interesting
we
question.
don't do it that way because that's a more of a tasty trade, tasty live. If you follow them on thing, that's something they used to preach a lot. They don't even do that anymore. They used to say, well, you want to get a third of the width of the spread. Here at Dorian Trader, we want to get a dollar amount and have a certain probability of winning. And so we explain that to members through course one, our foundational course. And so we're all about having a crazy high probability and collecting what we consider is a good amount of money. And then being having the ability to adjust that if required.
So you beat Delta into a lot of the folks into this conversation tonight.
Hmm.
Is that all? Is that all they need? There's kind of the question is like, is there something other than Delta that's important in this
So,
whole process here?
so I like to say that they have they have four major option Greeks. Some people say five with row, but no, it's four major option Greeks with delta, gamma, theta, and vega. And I like to say that you can disregard the other three and still be an option trader just understanding and mastering delta. But are you going to learn what gamma means? Absolutely. Are you going to trade a lot kind of looking at theta if you're a primary option seller? Absolutely. Are you going to understand Vega? Yes, but that's going to be the least thing you kind of follow is Vega. Out of those three, it's going to be the least.
Gotcha. All right, so we had someone register, and I want to make sure we don't have this problem with others. They
Mm.
they registered and they didn't get the discount, so it appears as though they got charged the 125. Can you show our website with the start now code for others that are getting ready to register? Make sure that's working. If it's not, we'll correct it on the back end. I've already told this individual that you'll handle this right after the call, is just to get the credit. But head out to the website real quick if you can, and
Yeah,
then
yeah. Let me do that. That doesn't that's interesting. I don't know if you remove the code there because if you go to the
mm,
website, this is the website here, and when you click that link in the chat area and you click it here and you go, you can see that it's already telling you that $30 there, and then it has down here to start now.
okay,
And
it's
so,
it's
but
working. It's working.
but for some reason, if you click something, I don't know what it was, and you actually got charged, let's just say $200, we'll reimburse you and get you on the right track. No
Yeah,
worries.
I'll send you that information. And
Yeah.
they ask a question about what happens now, and then the question is there a quick walkthrough of your website? They want to know
So
what's
so
next.
so absolutely, right? So what's going to happen is that you're going to log into the account, right? You're going to get access instantaneously once you pay, and you're going to have what is called our member dashboard. And on that member dashboard, it's going to be a button in two areas. The big red button that says get started here. You're going to click that button and then it's going to walk you through the steps you need to take. First of all, like using our on demand onboarding process. I'm telling you about our group onboarding every Tuesday night, telling you how you can schedule a one-on-one onboarding, telling you how to access your all your course information and telling you how to get connected to our Discord, telling you about our live programming, telling you about A, B, and C, all the different steps. And you'll get that information. And once again, if you have any questions, you can always email support. We're going to be there to walk you through things if we need to, but we try to make it as easy as possible by you just following the steps, right? No ambiguity, but it's always some, hesitation. And so we're there to help you.
Okay, I did a silly thing somehow. A gift button was clicked. Now I have a guest account with unclaimed URL. All right, so I'm going to send you this individual and you get them all set up. We'll get you all taken
Okay,
care.
so
We'll
yeah,
get you
so
all
that
set up
that
on the back
person
end.
that person clicked the guess button.
Yeah.
All right, so that's why they got charged the regular amount. Okay.
No worries. No worries. All right, so this is a little specific,
So the
but
best the best thing to do to if the easiest way if the guy is still on the call
yeah,
is go do it again and then I promise you I'll reimburse you that tonight.
there you
Just
go.
go do
There,
it again.
register for $30 as though you're a yeah, they're saying okay. I'm getting
Yes.
some
Okay.
she's going to do it. Perfect.
Okay.
All
Okay.
right, so here's a specific, O'Brien. This individual and many others, which is something that we know,
Mm,
when they first visit us, they have I don't know who these guys are. And then we tell them about our 6 years of doing this. And then they
mm.
maybe individuals come back often and listen to two, three, four, 10 webinars before they decide to join.
Yeah.
This individual appears to be in that ilk, right? and they're from the Woodlands, Texas area, and they're
Mhm.
interested in knowing whether or not we do any talking trades or physical gatherings in the Woodlands as opposed to, the other side of town. We started in Houston, therefore there's quite a few members in that area. Is there a way to coordinate
Yeah,
something in the
so
Woodlands in the future?
we we do a rotation, and we used to do it a lot regularly, but COVID changed things and all of that kind of stuff. But we're definitely going to get back on track of doing a lot of regular programming here in Houston because I am in Houston, and so we come to the Katy area, we come to the Woodlands, we come to Pearland. We obviously are Central Houston, so yes, you will see some talking trades in the Woodlands area
So how do
very
they find
soon.
it? Check our website. Is
Yeah, you
that the
just
best
check our
way to do it?
website. Yeah, you check our website
Cool.
under events, and you'll
Got
be
it.
able to see those things that are in person in the Woodlands.
Cool. Cool, cool, cool. All right. So you lost a few folks when you started the vernacular between a debit call spread and a credit call spread.
Hmm.
Let's take the word per minute down a notch and let's just walk through that one more time. The difference between and why would somebody do a debit call spread versus a credit call spread?
Okay, so a good point. I mean, good question. So if I go back over here, if we go just back to where we were looking at, I'm just going to pick anything here or pick the same thing. This right here, if you buy, using the same example, if you buy a debit call spread, you want when you buy anything on the call side, you are bullish. So you would use this because you want it to go up, but you want to pay a lot less than just buying a single call. And so what I mean by that is that right here you're paying $3 or $300. And then if you got rid of the spread and just bought a call, now you're paying $1,000, right? A little over $1,000 there. So spreading it off is going to be less capital used, and but you are paying a debit still. Monies are coming out of your account, and the most you can make is between the legs, right? We talked about a vertical leg being two legs all the time, or vertical spread being two legs all the time. This is one, and this is one equal two, and this is 5 points wide. We talked about how much that is worth. That's $500. So in this case, you can make almost 200 here if you purchased it for 304. Okay. And now if we flip this, that's when you're bullish. Okay. You buy on the call side if you're bullish. If you're bearish, you're going to sell on the call side. And so when you're doing a single call, if you're selling a single call, you theoretically have risks all the way, infinity into infinity, right? Unlimited risk. That's why it says its max loss here is unlimited. You can collect a lot more. In this example, you can collect that $1,000 if you sold this call at the 694.
That's a very risky thing to do at the money.
Yeah, but you do have a cushion, right? You have that $10 cushion. So is it gonna go up forever? No, but it could jump up, $20 and you're out of $1,000 or something like that, right? So that's how it can work. But if you want to define your risk, you can be bearish still and do a call spread. And so instead of receiving $1,000 and you're going to only receive 300, but instead of having unlimited risk to the upside, the max you can lose is 196. So you define your risk, you're bearish, but you kind of put a limit on, if you're wrong, how much you can potentially lose.
So sort of back to the original slide that you had about muscle memory, knowing
Mhm.
what you're trying to accomplish, being bearish or bullish on the call
Absolutely.
side. Got it.
Absolutely.
Got it. Got it. Got it.
Mm-hmm.
A couple questions came in on time frame. You
Mm-hmm.
mentioned 0, 7 day, 30-day, bread and butter. I mean, what's the right thing?
Yeah. So
How do you cadence this thing?
Yeah, so here at Dorian Trader, you guys, we have seven different strategies that we primarily do. Do we do other type of stuff? Yes, but we primarily do seven strategies, right? We do a zero DT trade, which is a day trade with options. We do that almost every day. For me and Dr. Meadows, we average about 4 times a week. We do a 1 DT trade, which means it expires the next day. I do that about 4 times a week as well. We do a 7 DT trade, and when I'm in the cadence, and sometimes I'm a little, busy, I do that, twice a week, but a lot of times once a week. And I did one today, a 7 DT trade. Now that we have what we call bread and butter. This is the type of strategy for the most part that I did in my fund for a decade, and that's a 30 to 60 day type of swing type of trade, and that's selling options, put spreads, call spreads, iron condors, things like that on indices, options on futures primarily. Okay. And then we have what we call the long dated strategy, which Ernie specializes, and that's selling options, naked puts or naked calls 6 to 18 months out. And you'll learn all about that. And then we have our signature strategy that we call the safeguard strategy. This is what we recommend most people put, if not everyone at Dorian Trader, put 80% of their monies into this because it's like buy and hold, but on steroids, adding gasoline to it. That's the book that you're going to get, introduce you to it for free if you decide to sign up this evening.
All right,
Now, and then
oh,
our
go ahead.
last strategy is an earnings play, and that's more of a kind of an engagement thing. We did some earnings on NVIDIA tonight, which was fun. We'll see how that plays out in the morning.
Cool. All right, last
Mm,
question because we've taken up a lot of time and it's time to go to dinner maybe.
absolutely.
Do you share your trades with us? That just literally just came in as you were talking about all these different strategies. How do you share these trades? What do you share?
So we share all of those trades that I just mentioned. Okay. In our Discord, you'll get all of those trades that we just mentioned. Okay.
Perfect. Yeah, very transparent.
Mm.
Everything that we're doing. All right, my friend, I think we have come to a point where you need to tell everybody it's their last chance for the next couple minutes here. Isn't that right?
So absolutely, guys. I want to thank you for joining this webinar. It's I know it's a Wednesday night. Some of you were on the webinar last night. We had this weird schedule that we have two webinars back to back
Yeah, that
at
was my bad for
yeah.
my earlier in the month
And
schedule. Yep.
it's all good. But we thank you for joining us for this webinar. We'll see you on our next one. And what I'm going to do is give you about 5 minutes before this webinar is over to still sign up, and you'll still get that deal. And so go do that and reward yourself, gift yourself, give yourself the gift that is going to be something that you thank yourself for years to come. Hey, you want to learn how to take monies from these markets. It's nothing else like it, making money off money. And we want to be there to help you in every way possible. So we're looking forward to getting to know you in the trading club. But if for some reason you're not convinced yet, come to as many webinars as you possibly can, ask as many questions as you possibly can. So thank you again.
Cheers.
Cheers, everyone. Have a great evening.
Good night.
Good
Thanks.
night.
Take care. Bye
Take
bye.
care, everyone.